Welcome to Value Investing, the Starvine Way, where my goal is to help you learn more about value investing and compounding wealth with a long-term focus. I'm your host, Stephen Coe, founder and portfolio manager of Starvine Capital. Today, we are reunited with Dr. George Athanassakos. He is a professor of finance and the Ben Graham Chair in Value Investing at the Ivey Business School. He is the founder and managing director of the Ben Graham Center for Value Investing and author of Value Investing from Theory to Practice, which was the subject of our podcast episode last year when George last joined us. What sparks today's conversation, and thanks again for joining me, Dr. Athanassakos, is your recent article on capital allocation and the role of a CEO. So first off, what sparked your interest in researching and writing about the qualities of effective CEOs and managers?
I've been looking at this for some time now, and there are two primary reasons. One is there is not much academic research linking capital allocator CEOs and stock performance, despite the fact that Buffett has been saying for years that capital allocation is the CEO's most important role. That's one, I guess, that nothing done in academia. So I thought it'd be interesting to look into it. And second, it's funny that if you look at academic research, CEO quality does not appear prominently in academic research. CEO quality is part of what we do as value investors as due diligence. But academics, because they think due diligence is a wasted effort, they don't pay attention to CEOs. And they think it's a wasted effort because for academia, what's important is diversification. They say, diversification will save us all. Don't worry about due diligence. Don't worry about business. Don't worry about management. And because I'm an academic, I want to bring this up to the focus and attention of academia that CEOs are a very important part of the corporation. They can make or break the corporation.
You're kind of a pioneer in terms of delving into this area then.
Mm-hmm. Yeah.
Next up, Warren Buffett. I'm aware that you've brought numerous class trips to see him. How has your interaction with him influenced your views on leadership and management?
It's not just the interaction with Buffett, because I've had more interaction and direct interaction more with Prem Watson, as you know. Both of these CEOs, I saw how important was humility, discipline, and integrity for them. And all these have shaped their career, and they made them what they are, and also made them attract the kind of investors who value this discipline, who value this integrity, who value this trustworthy management. We went to see Buffett a few times. Always he said, come down, I'll take good care of you. He delivered what he promised because we spent 2 hours with him in the board. I mean, remember, the guy's in the 90s, right? So he spent 2 hours in the board, standing up, fielding questions, talking to students. And then he said, okay, now we cover a lot of stuff. Let's go and relax a bit more, have lunch. And then he drove his own car, which impressed me. He had no entourage and was so kind with his time with the students, talking to them over lunch about life, taking pictures with each one of them, which at his age was a big feat because we had like 30, 40 students and he would spend time standing up. I wish the executive was so giving of his time and energy to students, but also to society as a whole. As far as Prem Watson, I remember when I visited with him one time, he showed me all these canceled checks of his multi-million-dollar deals he had made. And he said, George, I closed the deal with a handshake. My handshake was my signature. So people trust him, and so are his investors, his shareholders, because he's a person who says what he means and means what he says. And for me, this is the definition of integrity. And both Buffett and Prem Watson do not live an extravagant lifestyle. Very down to earth. They do the same thing that most of us do on a daily basis. So I admire this. And I think every CEO must show the humility, the integrity, and the discipline that these CEOs have shown. And he really affected me a lot. Because like I said, I'm an academic. I went through a PhD program. I never thought CEOs were important in my diversified portfolio. But now I start, for the last 20 years, talking to these people, I start to realize how important it is and how the academics have dropped the ball on this.
What strikes me is just how applied your research and your interests are to real investing. In your article published in June, you cited Buffett's answer during your class's in-person visit to the question, how do you choose a manager? And I found the answer that you shared quite surprising. Can you read between the lines for us why his seemingly simple answer makes so much sense?
I never actually thought about this. I thought maybe it was like kind of way to evade the question. But if you think about this, if money is what drives you, you always go to the highest bidder. So what Buffett, I think he meant, is that you need people who are committed for the long run. Buffett and all value investors are long-term investors. According to Buffett, his holding period is to infinity. He wants to hire people who will not leave, who stay with him for the long run, and who come to work excited and tap dancing about what they do, not about making money. It is what makes them happy. In this way, you also tend to attract quality shareholders that also have a high and long-term perspective, and they're there for the long run. So I think this is what he meant. And, we need people who are not driven by money, that they're passionate, they understand businesses, and they care deeply about businesses, not about money. Because like I said, if you care about money, you jump ship for the next bidder. And I've seen this with Prem and Fairfax are not hiring many new people, but the ones they hire, they want to make sure they are there for the long run. And that's why they're taking the time, and the candidates, they go and meet with every senior person in the organization, even less senior people, to make sure that they all agree that this person here is for the long run and not for the money. It's a very time-intensive process. And if you look at both at Fairfax and Berkshire Hathaway, most people who work there are there for many years. They don't have like a lot of turnover.
So there's no question that it works, but it's such a diametric opposite to the prevailing practices, especially stock options and a lot of share-based compensation, mostly tied to the short term. At the same time, you want the best talent. So it must be a difficult balance to strike. You want leaders that want to achieve. So definitely it's a much different approach.
You don't have a lot of turnover. You don't need to hire people regularly, but you want to take your time and make sure the ones you hire are because they love the business. Okay, they love investing as opposed to love making money. And I mean, not all people are happy with this. That's why not everybody is a value investor, right? True value investors are a minority. You have to wait, you have to be patient and disciplined to find the right person.
If we were to conduct a broad survey asking the general population what they thought the key role of a CEO is, I would expect most to answer something like to be a strong leader or to execute sound strategy. How does this compare to how value investors see a CEO's purpose?
So CEOs perform two roles. One is that of an operator. And most people think that that's all they do. And when you talk about a strong leader or a good execution, mostly we focus on operations. And most CEOs are good operators. They acquired the skill moving through the organization, and they became CEOs because they're good at operations. But most CEOs become CEOs without mastering the skill of capital allocation. They don't learn it on the way up. They become CEOs without mastering the skill. As Buffett says, and as William Thorndike, you must have seen his book, Outsiders.
Yep, one of my favorites.
You're right, yeah. They refer to capital allocation as the CEO's most important job. So what does it mean to be a good capital allocator? Well, it means that the CEO has the skills and the abilities to take all the cash the company produces and deploy it in the best value maximizing ways. Buy another company, pay off debt, buy back shares, pay higher dividend, reinvest within the company. So in other words, the good CEOs are not those who are good operators and operate to create value, but also those who are good value seekers. And to be a good value seeker, you must be a good investor, and particularly a value investor. And I find that the best CEOs are those who behave like value investors. They are frugal. They don't want to overpay for investments when they buy other companies. They don't want to overpay when they buy back shares, even though we know that most CEOs overpay for mergers, overpay or buy back shares at the peak of the market. They understand the business deeply. They care about the business deeply. They have discipline, they have long-term perspective, and they have integrity. It's something that they don't learn. No one teaches them capital allocation. And it's difficult, I guess, to find mentors if the CEOs don't focus on capital allocation.
Right. And this brings up an example of Warren Buffett when he mentored Katharine Graham when she took over Washington Post. From what I read, he educated her on the topic of capital allocation, kind of served as a teacher. But given just how new the skill about capital allocation can be to a new CEO, it could be completely foreign. Let's say the newly anointed CEO came up through marketing, for instance, and had no finance background. What can a corporation do in its grooming and succession process to avoid this trial by error approach?
The thing is that companies don't prepare for succession, unfortunately. If you look at surveys, they ask CEOs, have you prepared for succession? 70% said no. And when they ask them why, they said, well, we don't prepare to retire in the near future. You don't prepare for succession after you leave. You prepare for succession before you leave, right? So companies have to have a good, well thought of succession planning programs, good internal training programs to groom the next generation of CEOs. You need to have good mentors, and you mentioned like Warren Buffett mentoring Kathy Graham. Good mentors who are themselves good capital allocators to help the next generation see the way to capital allocation and importance of value creation. I don't think this is an issue of big versus small corporations. I think this is a problem everywhere. I think the problem here is more a focused or a not focused company. Complexity is bad. Simplicity is good. And I want to refer to GE. Jack Welch, he made the company very complex. The new CEO, Larry Culp, he simplified the company. We now see GE, which is a very diversified portfolio, do not have a very more concentrated portfolio, very high conviction portfolio. GE is now focusing on 3 segments on which they have an advantage, competitive advantage. And I always said, that GE has to focus in the areas where they dominate the product line, because fixed costs in this business are determined by the product line. So you want to dominate the product line to minimize your average cost. And this is what Larry Culp has done. The new CEOs, or the old CEOs, first of all, themselves have to understand capital allocation. If they cannot do it themselves, they need to get some training programs through some consulting companies. So most importantly, the CEOs have to focus on investments that have a return on invested capital over the cost of capital. And they've got to understand how to actually define this ROIC and cost of capital calculation, because many people confuse net income with cash flows. The correct ROIC to compare with the cost of capital is one based on cash flows. CEOs have to focus on good investments. And which are the good investments? Are those that have a return over the cost of capital. And once they find these investments, they've got to invest a lot of money into these investments. The more you invest, the more you're going to make in this case. And finally, they've got to understand that they've got to manage the company in such a way that they build the moat, they build the competitive advantage of the company. Even if you lose money in 1 year, the point is that you've got to keep managing in such a way that the moat gets deeper and deeper and deeper. And as the moat gets deeper, your competitive advantage increases. So these are some of the steps they have to understand CEOs, and then need to have internal programs within the company to mentor the next generation of CEOs. You've got to understand what creates value and how value is created, and then mentor the new generation.
You also mentioned discipline and integrity as crucial traits for managers. For a new incoming CEO, or any CEO for that matter, what are telling red flags that us external investors from the outside might want to look for?
Discipline is important, right? Humans have difficulty making decisions that entice sacrificing short-term pleasure for long-term, or even putting up with short-term pain for long-term gain. Tom Bruce calls this the capacity to suffer. So you need to have a long-term perspective and overcome any short-term challenges or temptations. And you've got to have integrity, because without integrity, you cannot be trusted. And for me, a CEO who says one thing and does a different thing is a reason to sell the stock, part of my checklist. Most CEOs focus on corporate earnings and quarterly earnings and try to beat the earnings every year, and they think that's very important. But this focus on short-term company announcements on quarterly earnings can set the stage for corporate fraud, because if you have pressure to beat the earnings, you try to do whatever you can to beat the earnings. I don't want CEOs to be extremely focused on quarterly earnings. And that was one thing I was unhappy with GE under Jack Welch, because that Jack Welch had a beat the quarter mentality, not actually a mentality to be a good investor and create value, but beat this quarter mentality. I don't like complex corporate structures. For me, it's a red flag. Too complicated corporate structure. It's difficult to understand, and it's difficult to see fraud coming. Enron had become so complex, and I read they had sent auditors to audit Enron. They sent oil and gas auditors. But Enron was no longer an oil and gas company, it was a technology company. No one could really figure out what the hell they were doing. So I don't like complexity. I like simplicity. I don't like extreme merger activity, especially unrelated mergers. I don't want people always doing deals. I don't like CEOs who tell me, don't worry, I've got my unique business model that I know what I'm doing. I don't like a lot of incentives with options because they will do anything to make their options in the money. I don't like extravagant lifestyle. I like people who are frugal, as value investors are. And I mentioned in my article in the Globe and Mail that if you had looked at the Enron parking lot, they're full of Maseratis and Porsches and all these kind of expensive cars. Of course, I don't want to deal with CEOs who had a history of violations in the past. I don't like to see CEOs that keep revising the numbers, restating the numbers. I worry also when I see the CEO's face on Forbes magazine. Too much attention enhances the self-confidence, their arrogance. They believe that they can fool anybody all the time. Interesting enough, one of the latest faces on the Forbes magazine, this lady with a blood testing thing. What was this?
Oh, Elizabeth Holmes.
Yeah, that was the face on the Forbes. And the other face was the crypto king, this guy who convicted recently for fraud and...
Oh, yeah, I'm drawing a freeze. It's almost like it was a good leading indicator
yeah,
to see where they get the most limelight.
I remember the Enron CEO, he was asked if he was smart. And he said, and I quote, I can still put on the podcast, he said, I'm fucking smart. So arrogant, okay? He was so fucking smart that eventually he ended up in prison because you can fool people some of the time. You can't fool them all the time.
Sounds just a little arrogant. So one of your findings was that superior capital allocator company stocks, they outperformed the inferior ones by 33% over 3 years, over several decades. But when you're tabulating such a finding, how do you separate between what you consider superior and inferior capital allocation? It sounds like a very manually intensive project that cannot be completed with a simple metric.
I mean, that was a challenge, of course. That's why there was no prior academic research looking at the performance of value CEOs versus the other guys. Because the challenge always was to devise a metric to be able to identify the value CEOs and separate them from the non-value CEOs. In my research, I examined goodwill to assets in conjunction with operating margins as a composite metric to separate the good asset allocators from the not so good capital allocators. Now, why did I choose these things? As you probably know, goodwill was amortized up to 2000. Starting in 2001, merger goodwill is no longer amortized. Instead, they are tested for impairment, and if it's found impaired, it's written down. Now, what this means is that the goodwill we observe starting in 2001 is of much better quality than the goodwill we saw before that. So nowadays, high goodwill to assets indicates that the goodwill has been tested for impairment and found to have value, whereas low goodwill to assets implies one of two things. Either the company has not been involved in mergers, that is only organic growth, or they have overpaid for mergers and subsequently goodwill was written down.
So if I could reword this for the layman, before 2001, any company who made a lot of acquisitions would have had to amortize their goodwill in an orderly manner. So if they made bad acquisitions, it wouldn't show in that regard. But after that, your goodwill, which is the price paid over tangible assets, is put to at least an annual test. So therefore, it shows some kind of rigor or some kind of standard that is met. Is that right?
Yeah, so the company normally would hire an evaluator who would value the goodwill. If the goodwill is found to have value, then they keep it what it is. If they found that the goodwill is not value, they will write it down. So then that's why I looked from 2001 on, and I use US data because there are many more companies in the US. So I looked at goodwill to assets over a 5-year period. If the goodwill to assets remain high or increased over this period, then I said, okay, I'm going to put these companies into the value CEO. If the goodwill went down a lot, I would say, no, I would put them in the non-value CEO. At the same time, CEOs who did not overpay for an acquisition are frugal, as value investors are, and mindful of controlling costs and not overpaying for labor or keeping excess assets on the balance sheet. This will ensure that the company's operating margins remain high. So that's why I examine companies with high goodwill to assets and high operating margins, with a combination indicating a value CEO. So companies with high goodwill to assets and high operating margins are managed by companies that are good capital allocators, whereas companies with high goodwill to assets that went down and low operating margins are companies not managed by good asset allocators. So we have these two groups of companies. Over a 3-year period, the good capital allocator companies outperform the not so good by 33% cumulatively. And my research also would enable somebody to anticipate a company's future stock performance by identifying companies that are managed by capital allocators. So I find that if your goodwill to assets are around 28% or better, and your operating margins are around 90% or better, there's high probability that the company will end up in the top quartile in terms of stock market performance at least the next 3 years.
I find that very interesting for a couple of reasons. One being that such superior capital allocator and operating companies, let's talk about Danaher, you would expect that, and Danaher does trade at a high multiple, you would expect it to attract a following and a premium valuation. But your study shows that, like, independent of valuation, that these returns were achieved. So just purely on the accounting information.
Yes, companies which have high goodwill to assets and manage at the same time to keep operating margin very high means that these companies did not overpay for the acquisitions. They integrate them well. And because they kept the operating margin very high, they also probably underpaid and cut corners. And the synergies where they created a lot of synergies and benefit the company's cost structure.
That sounds like a very creative approach to uncovering value and to separate the universe.
These are the companies that you want to buy and hold for the long run. These are the companies Buffett likes.
It was suggested that superior capital allocator CEOs, they attract the most patient and focused investors. And so that brings Constellation Software. That's a big winner I missed, brings that to mind. But as these superstar CEOs eventually, they do garner a premium valuation, how should a value investor think about valuation for such companies as to properly give credit in the investment selection process?
That's a good question, and one can think, I guess, in two different ways about it. I found in Canada, there were 41 exceptional capital allocators in Canada. In the US, in my sample, was 167 companies. So the companies with the capital allocators, there's companies that outperform. And then what I found interesting was that Lawrence Cunningham did this study also, and he found that superior capital allocator companies attract the most patient and focused shareholders. These are the shareholders with the longest holding period and most concentrated portfolios. They're not day traders, they're not traders, they're not indexers. These are the shareholders that Buffett calls the high quality shareholders. Then I look at Cunningham's research. I took the stocks he identified as companies with the most patient and quality shareholders, and I correlated these companies with my companies. I found that 80% of the companies correlated. That is, we always have the same companies, which means that good capital allocator companies tend to attract the most quality investors, the most patient investors. CEOs with long-term thinking attract shareholders with long-term thinking, which I found very interesting. Now, how about valuation? Now, normally you want to revalue the company, and if their stock is above the intrinsic value, you want to sell. However, what I find for these companies, strong capital allocation and the quality shareholders, for these companies, the intrinsic value is always ahead of the stock price. The intrinsic value is always ahead of the stock price. That is, the stock price never goes above intrinsic value. And that's why I think Buffett says that his holding period, when he buys a stock, his holding period is to infinity. Because these stocks have such good capital allocation, patient investors, patient shareholders, the intrinsic value keeps going up faster than the stock price. As a result, you never want to sell because it never goes over the intrinsic value. So for these companies, the question is not when to exit, because you don't want to exit, basically. You want to keep holding. For these companies, the key question is, when do I enter? Now, of course, here are the two schools of thought. One is, if the stock price is always below the intrinsic value, then the best time to buy is now, always. On the other hand, as a value investor, I want to have a margin of safety. So in this case, if you know that you determine the intrinsic value, maybe take a quarter or 1/3 off of the intrinsic value and say, I'm going to go in at this point. I'll just give you some margin of error in case you miss something.
Now, for the deep bargain hunters out there, I suppose what we're saying here is that when you identify these gems where the company and business fundamental strength is so strong that you can see a path of the intrinsic value compounding because money is being reinvested at such a good rate that because it is exponential by nature, that the price often doesn't over-reflect what the value of the company is. And so timing becomes less important, doesn't it? It's more about identifying that gem and, of course, making sure you're not overpaying and then just really holding on for dear life through all the extreme noise that's always in the markets.
Exactly. Absolutely. Yeah.
To finish off, a final question here, and that's your most memorable experience. So what has been your most memorable experience or conversation in your research on CEOs and managers? Because I know you've spoken to so many of them.
Well, as an academic, and I think I referred to this before, as an academic, my most memorable experience was when I realized that my colleagues don't care about management, they don't care about understanding businesses, and that they think spending time to understand businesses and management is a wasted effort. That was a big light bulb exploded in my head. As a non-academic, I think, as I said before, I don't like complexity. Complexity, even good managers have difficulty managing two complex companies. So what really impressed me about this is Jeff Immelt. Jeff Immelt was a previous CEO of GE, and he gave an interview 3 weeks before GE announced earnings. And the interviewer asked him to give him his idea of how the earnings will look. And he made the mistake to give a number, which 3 weeks later turned out to be totally wrong. I say, what's going on here? I mean, a CEO did not know 3 weeks before the numbers were announced what the numbers were. Now, I'm not saying that he's incompetent. I'm saying that GE is so complex that no one can manage this company. And we would say this, the last 20 years, GE did nothing, actually lost value. And since Larry Culp came, that made the company less complex and more focused. And we saw that the stock price of GE for the last 20, 30 years has done nothing. In fact, it gone down. And when Larry Culp came, he simplified the company. He made the company focus on 3 areas: aviation, renewable, and healthcare. If you look at the stock now and the spin-offs, put them all together, the stock more than tripled since May 2022, I think.
And I remember you had Larry Culp as a key guest speaker in your value investing conference a few years ago before the real turnaround was apparent or visible, wasn't it? I remember
that. I asked him to talk about whether he thinks GE was a value stock. And he said, yeah, it's a value stock. And I remember the Globe and Mail, you go to the Globe website, I gave an interview in May 2022. And GE had announced this, they're going to split up in November 21. And so in May 22, they asked me, are you buying any stocks? Is that a stock you're buying? And so I'm buying GE. And everybody said, GE, this underperformer, this big company, you don't buy small cap, you don't buy. And that was the right thing to buy. Okay? GE at the time, now it's still time's up. And the other thing I want to mention is important also. I mentioned trust. Trust is very important, especially when you give somebody your money to manage. A memorable experience for me is when Francis Chu in 2008, his portfolio having gone down during the Great Recession, he returned to his clients all the fees he charged them. How many managers did this? No one. In fact, the association made his life difficult. And as far as I remember, he had to go to court to defend his right to return to his investors.
That sounds pretty absurd.
You know, this guy is working for you. I mean, if you make money, he makes money. If you don't make money, he doesn't want your money, your fees. So little things here and there, they give you impressions about people and about companies.
The closest thing I've heard of that is a fee holiday, but to actually write a check and send the fees back, that is quite a standout thing to do.
Yeah, very unusual. But again, Francis is unusual.
Yeah, that's right. Dr. Athanassakos, thank you so much for reappearing on my podcast. I think the guests have a lot to learn from you, and this topic in particular is fascinating, and I'm sure it is going to strike a lot of people in a good way.
And I talk about all this stuff in detail in my book, Value Investing from Theory to Practice. You can buy it only at the Western bookstore so that the money stays at the university.
And I've read it, every single page of it, and I would certainly endorse it. So if you're looking to learn more about value investing, I recommend you buy that book.
Thanks, Steve. And you were a good student. I remember that's why I give you my time, because you were a good student and I want to involve you as much as I can. My center here, and I know you're part of my advisory board for the value fund we have. So I hope you're enjoying and staying with the fund. We help students learn.
It's a great way to give back, and it's an honor to serve on it. So thank you for having me on it. Right.
Good.
George, thanks again. And with your travels, I hope everything goes well and you stay healthy.
Thank you, Steve, and good luck with you.
Thank you. We hope you enjoyed this episode. If you did, please like, subscribe, and share. Questions can be sent to podcast@starvinecapital.com. On a final note, thank you for the online reviews, as that helps us get discovered.